Hi friends, the Indian stock market outperformed the emerging markets and the US from 2021 to 2022. The Indian equities gave a return of approximately 19% in FY22 and 22.3% from April 2021 to April 2022. In the midst of the dark clouds hovering around the global economy and increasing volatility in the market, we shall try and find out where the stock markets are headed in the future. The global economic environment has been tumultuous, with the world just emerging from COVID-19 crisis. While the economies were hoping to get back on their feet, yet another black swan event, the Ukraine-Russia crisis, led to high volatility in the stock markets. This event led to severe energy crisis, with the prices of crude oil touching peak of $139 a barrel and gas prices as well as rents skyrocketing to 8.5%. This led to a severe rise in US inflation as it hit a 40-year high. In order to curb the inflation, interest rates are expected to rise in major economies including Europe and US. A major economic event happened in March, with the US Fed hiking interest rates and announcing the possibility of 6 rate hikes during the year. Fed officials raised rates by a quarter point last month, and it is expected to lift from 0.5% to 1.9% by end of 2022 and 2.8% by end of next year. Full year US GDP growth is projected to grow around 2.5% in 2023, down from 4%, which was predicted earlier by the Fed, signaling a slowdown. In the midst of these dark clouds hovering around the global economy, India saw a pickup in investments in the infrastructure sector, and the improving credit uptick of the banks looks very encouraging. Consumer confidence is also gradually improving. On the negative side, however, India's dependence on imports of oil and industrial commodities has widened, the current account deficit and inflation is also on the rise. The Reserve Bank of India recently revised upwards its inflation forecast to 5.7% for FY 2022-2023 from 5.3%, citing surge in commodity prices. Overall, the RBI's policy moves are a continuation of a gradual withdrawal of an accommodative monetary policy and paves the path for gradual rate hikes in June or August 2022, depending on upcoming macro data. The Reserve Bank of India has pegged the economic growth rate for 2022 to 2023 at 7.8%, down from 9.2% expected in 2021-22. Net-net, this will result in downgrades of earnings estimates in several sectors that are sensitive to inflation and interest rate fluctuations. Weaker demand and higher input costs will be the key reasons for cuts in estimates for FY 23-24. The overall weak global sentiments and continuing geopolitical risks will weigh on Indian equities as a significant portion of Nifty ownership stays with FIIs, and a high share of global earnings constitute Nifty earnings. While FIIs have continued their selling spree, the rally has been primarily supported by DIIs. At the current level of 17,038, the Nifty is fairly valued and trading at a forward PE valuation of 23.6 times. Given the uncertain times, we believe the market will continue to remain volatile with a downward bias. Hence, the investors' approach should be slightly defensive, and hence they should focus on large caps, focus on sectors such as banks, IT and defense sector, and be selective in choosing companies. However, if technically Nifty levels of 16,500 are broken and it sustains below it, one can expect more weakness in the markets. Having looked at the fundamental factors, we now shift focus to technical indicators and technical charts with our expert Mr. Kapil Mokashi for his view on the markets. This is Shah signing off. Thank you.
Hi everyone, let us have a quick technical check on Nifty index from a medium-term perspective. Since our view is medium-term, we will be using weekly, monthly and quarterly charts primarily for our analysis. On the quarterly time frame, one can observe markets have been totally range-bound since December 2021. Formation of two dojis candles back-to-back just validates that view. If you observe the current quarter candle in progress, it is no different and we are having another doji in the making. A doji is an indecisive pattern with a very small range and almost equal open and close. Contrary to popular belief, dojis are not always dangerous and signal a downfall. They could either suggest a pause in a potential uptrend or a reversal of an uptrend. As always, when we read any signals in technical analysis, it would be wrong to form an opinion just on the basis of one parameter like a doji candle. To form a decisive outlook, we would rather analyze and understand what multiple technical indicators and what multiple time frame candlesticks are suggesting us. When we look at the multiple time frames of Nifty, what we realize is that not only the quarterly time frame is suggesting indecision, but even the low time frame charts like monthly and weekly are suggesting the same sideways trend. If I usually look at the Nifty trend on the weekly time frame, it is clearly pointing sideways. And when I apply a 20 exponential moving average, we can see it is clearly almost a flat line, suggesting a sideways trend. The upper end of the range is marked by a resistance area of 18,300 to 18,600. At 18,300, we have a bearish engulfing candle, and 18,600, we have a dark cloud cover candle. Thus, that entire cluster is a strong area of resistance, and Nifty would find it really difficult to cross those levels easily. Similarly, the support area is marked by an engulfing bull candle at 15,670 to 15,880 levels. The same picture is seen on monthly charts with the development of a probable indecisive candle towards the end of April. I say probable because we still have a couple of days in this month's session to remain. The technical indicator RSI is around 50 levels on weekly time frame, which again reaffirms our sideways outlook in the markets. All in all, what it means is market would continue to remain choppy, directionless in the months to come with a very high volatility in the interim. If you are holding stocks and wondering whether to book profits or to continue holding, the key level that you need to watch out for is 15,500 on the downside. A break and close below this level on daily or weekly time frame should be a signal to exit. But as long as that level holds, there is no reason to panic, and it is quite possible that markets would regain their upward momentum post 3 to 4 months of sideways movement. If you are considering making a fresh investment, be stock specific and stick to the stocks which offer a good reward to risk ratio. We would make another video on where do we feel such opportunities lie in the upcoming months. Till then, thanks and goodbye.
This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing. Thank you.